Welcome to the show. I'm Kim Parley. Thank you so much for joining us tonight. And my apologies again for my bandage. Bear with me. It's getting better soon. Well, the Fed issued its first rate announcement since Trump became the president of the United States. And as expected, there was no change to policy. But for some perspective on perhaps what we should be watching and what we should be listening for with regards to the Fed and everything else that's going on, we're joined by Michael Craig. He is Senior Portfolio Manager at TD Asset Management. I say everything. I think I almost roll my eyes when I say everything because it's just utterly exhausting keeping up to what's been going on. But let's start with the simple stuff. Janet Yellen, the Fed, came out today. What stood out for you in terms of what they said or didn't say? It
was quite a quiet and uneventful meeting today, which was a bit surprising. The market wasn't expecting much, but I would have thought they would have made some reference. They did talk about sentiment in the U.S. improving, both in the consumer and manufacturing sector. So things are getting better, and these trends were well in place before the election. So nothing new, and expectations for rate increases didn't change.
Now, was it with the data? I'm curious because the one thing I did note was the fact that sentiment, they noted it was better. But is that backward looking? Has that changed? I mean, because things have just been so rapid fire since President Trump has come in. I mean, we've lost count of the number of orders that have come in. We all follow the headlines and have seen some of the chaos that has ensued. So do you think that optimism is still there?
I think globally there's been an uptick in growth, not only in the U.S., but also in Europe and other jurisdictions. And so, again, these trends all emerged in the late summer, and now they're starting to mature somewhat. So the cyclical backdrop is probably near the end. And so Trump certainly gave it a kick with his election, with the belief that deregulation and fiscal spending was coming. So that certainly added more juice to this. But this is just a cyclical cycle like any typical economic cycle is.
Okay, but I would say the political cycle is probably different than any other political cycle we've seen.
Much more eventful.
Yeah, so let's focus a bit on that. And because I'm curious about your thoughts on what you're seeing right now, because I've heard everything from, that President Trump is going to be here for 8 years. I've heard to people utter chaos right now. So you, as an investment professional, I mean, what do you do with all this information, and what are you thinking? What do you think that we need to be thinking about right now?
The key thing I would mention is that the volatility or the risk aversion in the markets is very low. People are way too comfortable with what's going on at the backdrop. If you think about Trump, in the summertime, he said a lot of crazy things, but a lot of people who supported him just dismissed it as election rhetoric. He was very, on Trump's standards, very conciliatory after the election. He mentioned, what a great campaign Clinton had run, and the markets did a V. Basically, as the election night proceeded, markets sold off, and as soon as Trump spoke, they rallied into the next day. And so that fed a lot of optimism within markets, and we had a very great rally in November and December. Now, with the first 12 days of his candidacy, or his presidency, I think we started to realize again that the Trump president is actually quite similar to the Trump candidate. And for the first two policies, he started off a trade war with Mexico and caused chaos at various airports. And so these aren't necessarily the pro-growth deregulation policies the market was looking for.
It's interesting because you're absolutely right in terms of, I think people looked, the tax cuts, they looked at the fiscal policy as what it could do. But I always talk about like friction costs and chaos. And I mean, we don't know what they are yet, but they seem to be rising. I mean, I'm just thinking about talking to lots of people at companies now trying to think about, well, can we send these people over here? Can they come back? Airline stocks, for example, dropping 4 or 5%. So are we going to see, is that going to outweigh the other stuff?
Well, the U.S. has had a competitive advantage for decades, drawing some of the best people from around the world to work there. And even though he hasn't targeted, highly educated, engineers, for example, I think many people who aren't from the U.S. who are working there today are asking themselves what's next. And so it set off a bit of a fear within the United States, totally unnecessary, by the way. And so this is not, if you think about it, the big question is Trump good or bad for the markets? Well, the question is in 4 years' time, is the U.S. going to be more productive than it is today? And so far, his policies have been anything but supporting productivity. And so as a market perspective, you have to keep that in mindset when you're looking at equities.
When you and I were chatting beforehand, I mean, you talked about just basically let's temper our enthusiasm, if you will, for that Trump rally, I guess that started up at this point. When you look sector specific, I mean, I think again there's a few unknowns here because I mean trade obviously the border is going to impact so much, but the airline sell-offs and those types of things. What do you think when you see that?
Well, his policies are inflationary. And so for sectors who have sensitivity to that, it could be problematic. I have to think that if you're an automaker, having to shift production from Mexico to the U.S. is going to increase your costs. And so it bears question whether they can pass those costs on to consumers. The tech sector would be another area where they really need, there is a skills shortage in the U.S. They really need to draw in people from other countries to fill those skill gaps. And if immigration becomes more challenging, they're going to have a harder time filling those gaps, and that will ultimately lead to more wage inflation. So those are the things that we're thinking about and could be problematic with his policies going forward.
So when you show, again, investment side on, so when you're looking at this, what's an investor to do in this environment? I mean, there's just so many unknowns right now, or are there? I mean, are the headlines kind of blowing things out of proportion?
We don't changing our investment approach totally dramatically. We're using what we've used before and being mindful of his policies and sometimes trying to take advantage of the volatility he's causing to reset positions. But our work would show us that cyclically things are pretty good, are pretty hot. But structurally, we're in the late stages of this equity rally, and that was the case before Trump, and nothing has changed. And so we're kind of tempering our enthusiasm. I think we like equities. We like them more than bonds right now. But we are mindful that this is a multi-month view, but in the next few years, we are likely to hit for more challenging markets than what we've seen for the past 3 years.
Michael, always a pleasure. Thanks so much.
Thank you.
Michael Craig, Senior Portfolio Manager with TD Asset Management.